This video will cover financial intermediation. It's a pretty cool chapter. We're going to take a step back, take a 10,000-foot view, and ask why we see so much financial intermediation versus direct investment in our economy and in other well-developed economies. So what is financial intermediation versus direct investment? Well, direct investment is basically you direct where you want to invest your money. So if you decide to invest in Apple stock, contact a broker while the broker is an intermediary to help you do that transaction. It's really direct investment because you have directed the investment and you've decided what to invest in. As a saver, you've put your money into a specific stock. Financial intermediation comes about in this course, and what we're defining it, at least in this chapter. Financial intermediation is where you give your money, say, to a bank, and the bank decides who to lend it to and where that money goes in terms of an investment. So that's the distinction. Then we'll talk about the lemons problem, why some markets break down, and then we'll use the concepts of information asymmetry, adverse selection, and moral hazard, which you may have seen in a risk management and insurance course. We'll talk about that in terms of financial intermediation and why we see so much financial intermediation. That's where things really get cool in this chapter. It's very enlightening. And we'll apply the concepts of information asymmetry, adverse selection, and moral hazard to financial institutions. So let's start off and let's get a little bit further into what financial intermediation and direct investment represent, so we're just a little more clear on that. And then we'll move on to the lemons problem. So let me go to pencil and paper. So let me try to discern between financial intermediation and direct investment. So you as a saver, let's say you're a saver here, and then there's a borrower here. And I'm using the word borrower in general. I mean, it could even be people that need equity investments. But basically, you have a saver and somebody who's dissaving and is going to take the money and invest it. So the money basically goes in this direction. There's two ways that can happen now that we want to focus in on in this video. And when you save money and you give it to a borrower or you buy equity like stocks and bonds, if you're the one who is making the decision on who to lend it to, which stocks to buy and which bonds to buy, then that's direct investment because you are directing the acquisition of these assets or the lending of money. There could be an intermediary in there, but that's not the intermediary that we're referring to. And what type of intermediary would be here? Well, it would be, for example, a stockbroker who can help you buy stocks and bonds. So that's direct investment. Now, there's another way you can invest your money, and that's through a financial intermediary. And what I mean by a financial intermediary is a pension fund, a mutual fund, a hedge fund, private equity, and banks, and savings and loans, and so on. And what they'll do is they'll give the money to, for example, a borrower, or they'll buy the stocks and bonds. So what you end up having is you have an intermediary. Why is this an intermediary that's different, say, than a broker here? Because this intermediary is making the decision for you as to who to lend to, which stocks and bonds to buy. Here, you are self-directing it, basically, and using a broker. But here, you could actually be sending your money in to a pension fund, a mutual fund, a hedge fund, banks and savings and loans, and you don't have a decision on who they lend to. That's their business. And so this is financial intermediation that we want to look at. Why does this happen? And if you look at the statistics, you'll find that, while this stocks and bonds make the news all the time, there is a ton of activity. There's trillions tied up in bank debt and pension funds and mutual funds and so on. So the question is, why is this so popular? And what are the implications of this? Well, right off the bat, one of the reasons why. Because one, these guys can generate economies of scale, and as an individual saver, you and I really can't do much. I mean, maybe you scrape up a couple $1,000s and you want to lend it to somebody. Well, you're probably not a good credit analyst in evaluating whether or not that person will pay you back, and then you probably don't have the legal expertise to be able to do that, and to be able to evaluate collateral, for example. So if a borrower doesn't pay you back, what do you do? Well, that's a problem. You can contact the lawyer, but by the time you get done with legal fees, costs are greater than the loan you made. Financial intermediaries, they have departments that will handle that, entire legal teams that will help with that because they got economies of scale. These guys are managing billions of dollars at a time. And they got analysts that know exactly, how to evaluate stocks and bonds, and credit analysts to, make lending decisions. So what we want to do is we want to focus in on this box here, this financial intermediary box. What else is going on here? What is the underlying concepts? And it turns out that the underlying concepts are information asymmetry, adverse selection, and moral hazard. And if we understand those concepts, we can get a better understanding of what's going on here, especially in terms of banks and savings and loans. And we're not going to look too much into pension funds and mutual funds and hedge funds and so on. We're primarily going to look at the lending aspect of things. What you learn from banks and savings and loans is applicable to a lot of other businesses. So what exactly is information asymmetry? Well, information asymmetry, I like to say, is in the air. It's in the environment. It's always around. And what do I mean by that? Well, what I know is different than what you know. So information asymmetry results when one party has a different information set than another, which happens all the time. For example, a banker doesn't know the potential borrower's character and their history. An insurance agent doesn't know the true background and risk of a potential customer. And a used car buyer doesn't really know the exact quality of a car that they're contemplating buying. Much of the business world is about trying to eliminate that information gap to alleviate risks. And then there's the adverse selection concept. The adverse selection idea works like this. The people who are least likely to pay you back are the ones that are going to be seeking a loan. The people that are the highest risk in terms of insurance are going to want to buy insurance from you. So it turns out that if you lend money or you sell insurance, some of the worst people are going to come to you, and they're going to look for loans, and they're going to look for insurance. That's called adverse selection. And then the idea is, what happens after you make the loan or you underwrite the insurance? Well, then what happens is you have that moral hazard issue, because moral hazard is something that occurs after the fact. So you borrow money, you tell the lender, look, I have all these projects that I want to invest the money in. They're safe, they're good. I think they're going to be really good investments for me. And, you're likely to get your money back. But you never know what the true intent of the borrower is. The borrower may be saying, look, thinking in their head, actually I'm going to speculate with this money. I really don't know what I'm doing with it. And if I hit a home run, that's great, because I'm using the bank's money to speculate in this area. And if I hit a home run, I'll pay off the bank, and then I'll keep the rest, which hopefully is a lot of money. And so that's, a highly risky investment. And then if it comes down to insurance, well, what does that mean? Well, it means once you insure a person, do they become more reckless once they know they have insurance? That's moral hazard. So adverse selection happens before the transaction takes effect, and then moral hazard takes effect after the transaction has occurred, after the loan has been extended or the insurance has been underwritten. Now, what we want to do next is we want to go deeper into these ideas of adverse selection, in the environment of asymmetric information and the idea of moral hazard. We want to look at that closely to see how markets break down because of asymmetric information, the adverse selection problem, and the moral hazard problem. So what I'm saying is the environment is asymmetric information, and because there's asymmetric information, human behavior of adverse selection and moral hazard causes problems that make markets break down. And it's the fact that we just don't have the same information between the saver in the borrower or the user of money. For example, so let's look at what's called the lemons problem that was developed in the late 60s by George Akerlof, which is quite insightful. Now here's the idea. Let's look at it. He did this in the car market, and I think it's easy to look at from a car market perspective. Let's say that good cars, peaches, are worth $20,000, and lemons, which are bad used cars, we're talking the used car market here, are worth $10,000. Okay, so that's the used car market. And think of this as years ago. It turns out that if you have a really good car, you're going to want $20,000 for it. And even if you have a bad car, you're going to want to try to get as much money for it as possible. And only sellers know whether or not the car is a peach or a lemon. And it turns out the buyers are going to have a hard time determining whether a car truly is a lemon or a peach. And so there's an information asymmetry in the used car market. And because of that, the market tends to settle at a price of around $15,000 for a car. The average, saying, assuming there's a 50% peaches and 50% lemons out there. So let's see what happens when you have a $15,000 price. Well, the people who sell peaches, they're not going to want to sell their car for $15,000 when it's worth $20,000. So these peaches are not going to be in the market. The used car market, you're not going to see too many of these peaches. Now, when it comes to lemons, you have a lemon that's worth $10,000 and the average price is $15,000. Well, of course you're going to want to try to sell your car in this market for $15,000. And so what happens is the market for used cars gets inundated by lemons. There's probably going to be a few peaches in there, but it gets inundated with lemons. So there you have an example of asymmetric information. People don't know the real value of a car. And then you see people taking advantage of it, and you see the market falling apart because of adverse selection. Now let's look at this in terms of finance. Let's say lending. So let me move out of here and rewrite the problem here for lending. So let's assume that we have a lemon borrower or borrowers, and we have peach borrowers. And the lemons, these are the people who are not likely to pay you back, pay a banker back. And let's say they should be charged a fairly high interest rate because they're risky. So it's some type of interest rate. It could be a real rate plus an inflation premium plus some type of, you could say just plain old DP, default premium. So the interest rate is fairly high. Peach borrowers who are low risk individuals, good stewards of the money, they ought to be charged 5% because they're just low risk. Bankers are going to look at these two. They know there's lemon people out there. They know there's peach borrowers out there, but they're going to have a hard time distinguishing the two. So they're going to come down in the middle there and charge interest rates of 7.5% for all borrowers. Well, 7.5% is really attractive to lemon borrowers because lemon borrowers know they're highly risky. They're not going to tell the banker that, but they know they should be charged 10%. And so 7.5%, that's attractive. And then the peach borrowers are going to look at this and say, look, we should only be paying about 5%. 7.5% is too much. We'll find our money elsewhere. We're just not going to borrow. And so there you go. The lending and borrowing market breaks down because of asymmetric information and then the adverse selection problem. But now with borrowing is a little more involved than the used car, because with the used car, you just get the car. If it's a lemon, you get it and that's it, or whatever. Or you get the peach, that's it. There's an added dimension to risk, and that's the moral hazard. Once the money has been committed and the borrower goes on the way, they can change their behavior and behave in ways that you can't monitor and you can't check. And so the probability of you getting your money back is reduced significantly. And the same thing with insurance. Once an individual gets insured, they go off, they can act as risky as they want, knowing, the insurance company will pay me off if I get into an accident. That's the moral hazard element of things. And that throws a wrench in the markets for both insurance and for lending. So now let me summarize what financial intermediaries can do for us. in terms of what we've just discussed, and even a little more. So first off, we have the ability of financial institutions to pool savings and to cut down costs, which are the economies of scale that I'm talking about. That also, by the way, helps with diversification. So if you tried to do this yourself, and you wanted to diversify your lending, well, let's say you had $10,000 to lend, and you'd have to go through all the hassle to figure out, is this person really a good person to lend to? Are they a peach or are they a lemon? But you'd have to lend your money to a lot of different people to get diversification. You'd want to lend your money to people in different areas, different industries, different reasons for buying it, and so on. Well, a bank can do that for you. So banks have the ability to diversify geographically by having people in different locations. Plus, they have different people who specialize in different areas. Auto loans, boat loans, commercial and industrial loans, and commercial and industrial loans that go into specific sectors and areas and industries, and mortgages, and so on. So banks are required by regulators to have diversified loan portfolios. The Federal Reserve, for example, comes in and audits financial institutions, banks, and checks to make sure that they are diversified. And that comes into play when they do stress tests to make sure that the bank can withstand a shock in a certain area of the economy. Stepping outside of the banking world for a moment, you can look at pension funds, hedge funds, mutual funds, insurance companies that invest in thousands of different assets across the economy. That not only helps the company itself with diversification and reducing its risk, but it also has a macro effect, a macro-prudential effect, a topic that we'll be covering later on. So let's move back to banking again and look at the benefits of intermediation. Then there's also the collection of information. I mean, these guys in banks are really good at collecting information. Let me give you an example. So when you borrow money at a bank and let's say you're a business and you borrow money, well, the banker's going to keep tabs on you, so to speak, even though you don't even realize they're keeping tabs. And how are they going to keep tabs? Well, they might visit the client under the pretext of going to a meeting or going out to lunch or even picking somebody up to go golfing or even a social event. So I worked as a senior financial analyst in a bank holding company for 5 years, got to know a lot of lenders, and boy, they pride themselves on knowing their clients and their customers really well, beyond the financial statements that were handed to them every quarter from the client. Yeah, these lenders visited offices, just check on how things are going very subtly. They may take note as to what you're doing in the newspapers. They will also ask you to hold the cash in a bank account. So when you borrow money from a bank, they put it into your checking or savings account for you. And they can monitor that checking or savings account for you. So they're not going to deposit the money in another bank. They're going to deposit the money in one of their own accounts for you and monitor it to see what's going on with those balances. And they'll have good relationships. So part of that good relationship building is you're gathering information at the same time. And another benefit of financial institutions is that they're going to have much better record keeping probably than you would have as an individual. And they're going to also provide safekeeping for assets, so your money will be insured, and we'll get to that later when we get to FDIC insurance. And not only that, the bank can provide liquidity. So you put your money in the bank, and they're going to lend most of it, but if you need to pull money out along the way, you can. You can write checks have demand deposit accounts and write checks, and then also you have access to ATMs and withdrawals. So there's lots of benefits associated with financial intermediaries. None of that comes free, by the way. There's costs involved, and the infrastructure to have all these aspects of a financial institution are expensive. Okay, so now what I want to do is I want to talk another benefit of financial intermediation. But before I go there, I have to develop the concept. And it works like this. Okay, we have asymmetric information in the world. It causes a problem for businesses, especially banks. And so how do we go about mitigating that? So there are two ways we can think of mitigating the asymmetric information problem. The first one has to do with a public response, and the second one is a private response. And what we mean by the public response is government regulation. So, for example, we have the Securities and Exchange Commission with lots of regulations on what companies have to disclose. And so they're covering the stock and bond market in a sense. So they're looking for disclosure requirements for stocks and bonds because stocks and bonds trade amongst the public. And so that organization makes sure that the information is fairly quickly disseminated to stock and bond holders and to the public. Financial intermediaries are also subject to that regulation because they issue stocks and bonds to fund their assets. They have to comply with the Securities and Exchange Commission. Now, banks have to comply with the FDIC Deposit Insurance Corporation because banks are insured by that organization. And so that organization sits on a gigantic fund that insures deposits. So your deposits at a bank are insured up to $250,000, and they want to make sure that fund, the risk to that fund is minimal. And so that's what FDIC disclosure requirements are all about. There's also Federal Reserve disclosure requirements, and the Federal Reserve looks to keep the banking system stable. And so their regulations are designed to monitor the banks. Because as we'll see later on, if one bank fails, there's a tendency for other banks to fail because they're very connected to each other. So it's the FDIC, it's the Securities and Exchange Commission, it's the Federal Reserve, that's the public response. It turns out that the public response doesn't completely eliminate the asymmetric information problem. Just look at WorldCom and Enron and other financial scandals. Even though we've had mountains and mountains of regulations that the Securities and Exchange Commission, the Federal Reserve, and the FDIC have, it still didn't close the gap because people didn't fully understand what was going on within those organizations. And investors lost millions. There is also a private response. So think about it. If there's asymmetric information and it's a problem, well, there might be some money to be made in trying to fill in the gap between the information that people have. Well, it turns out there is some private mitigation. And that comes from such organizations as Value Line, Dun & Bradstreet, Bloomberg, Morningstar, which covers mutual funds. And what they do is they collect information privately and sell it through subscriptions. But it turns out that private response to trying to solve the asymmetric information problem, that doesn't really work either. And I say either. I'm saying that the public response, the Securities and Exchange Commission, FDIC, and the Federal Reserve, they don't fully close the information gap. Neither does the private response either. And so why does the private response tend to break down? Why does the private market for information tend to break down? This is where things get interesting. And this is where banks and financial intermediaries solve that problem. And the problem is this. Information can flow freely, and once you buy information and you get a hold of it, the cost to replicate that information, the marginal cost, is almost zero. So you can get a subscription to Value Line, for example, collect that information, and then disseminate it to other people very, very quickly with very little costs. And so what that's called is called the free rider problem. The free rider problem means that the organizations that collect and sell that information can't get the full value for it. Information is not a pure private good. And the reason for it is it's non-rivalrous. And what that means is more than one person can consume the good at one time. It's not like a hamburger. You buy a hamburger and only one person can consume it. There's an infinite number of people that can consume information at the same time. And so information that can be reproduced with no marginal cost on a non-rivalrous basis, you can see that it's not going to solve the asymmetric information problem. The free rider problem pops up with private information. Private information, therefore, will be underproduced. Therefore, we have a public response that doesn't quite fill the information gap that's out there. We have private response, and because of the free rider problem, that doesn't quite fill in the gap either. So how do banks actually go about that? How do they actually solve that free rider problem? This is where it's interesting, because banks and similar financial institutions hold that information within the bank, within the institution. It's not made public. So they may get lots of information on what their clients are doing. And when they get that information, they keep their lips sealed. And that's a strong motivation for clients that have projects that they don't want the public to know about. and they want to fund it, they go to a bank or a financial institution that can keep that information private. If those companies were to issue stocks and bonds and then have to go through the Securities and Exchange Commission, well, their information would have to be made public. You go through a bank, a financial intermediary, you give them that information, they're going to keep it locked up. And so it solves the free rider problem. And so there you have it. Another strong reason why you see so much financial intermediation in our economy relative to issuance of stocks and bonds. Now that we have a handle on asymmetric information and its problems, let's use it in evaluating situations in finance. So when you're faced with a situation, ask yourself, does it involve asymmetric information? And you may have to use your imagination to answer that question. And then if you do answer the question in the positive, is there an adverse selection problem? Is there a moral hazard problem? Is there both? Is both moral hazard and adverse selection present in the situation or possibly present in the situation? And can there be a situation where you have asymmetric information but no adverse selection and no moral hazard to be seen? Yeah, so these are some questions we need to ask ourselves. So let's look at an example I think that's cool. We'll look at several examples, in fact. The first example is collateral. Can collateral mitigate the situation of asymmetric information and its problems? So a bank extends a loan, and it often requires collateral. So you buy a house, for example. You get a mortgage. The mortgage is a loan. And what is the collateral for that mortgage? Well, obviously, it's the house and the real estate that's attached to it. So in the mortgage situation, is there asymmetric information involved? Does the bank really know who the borrower is? And the answer is no. The bank probably deals with thousands of different customers in terms of mortgages a year. They won't fully know who's borrowing the money. And then the next question becomes, okay, so let's assume that there's collateral now. The house is used as collateral. What can that tell us? Does that reduce asymmetric information? And the answer is yes, it does, because the value of that collateral is important. The bank is going to want to assess that collateral. So if you're getting a $100,000 mortgage, meaning you're getting a $100,000 loan, what is the value of that collateral? Is it really worth $100,000? Well, the bank is going to reduce that asymmetric information by actually visiting the property and noting where that property is located to see whether or not it's worth $100,000. And then the question becomes, well, does the collateral for a mortgage reduce adverse selection? By the fact that the bank evaluates the value of the property, prevents people from obtaining loans who could not otherwise obtain a loan. So in other words, if an individual wants a $100,000 mortgage, they should have about $100,000 worth of property to put up as collateral. So it does solve the adverse selection problem. There is a mitigation of asymmetric information. And then the question becomes, well, what about moral hazard? Does collateral reduce moral hazard? And the answer is yes. Usually with a primary residential mortgage, you're required to live in the house for a majority of the year. And if you have a primary residential mortgage, then that mortgage is usually the lowest rate you can get. What the bank wants you to do is actually live in that property. And the fact that you're living in the property means that you're going to maintain the value of that property during the life of the mortgage. In that way, there's minimal amount of monitoring that's required by the bank. The bank may send you occasionally questionnaires asking whether or not you're living in that house and whether or not it's your primary residence most of the year. Oh, and don't forget, the lender is going to require the homeowner to have homeowner's insurance. That's another way that protects the collateral and reduces moral hazard to the bank. So obviously, there's a lot more going on to mortgage lending than just looking at collateral. Bankers have a saying that says, look, collateral doesn't make a good loan. Also involved in this is background check on the borrower. Does the borrower have a good job? Is it a steady job? What's their credit score? What was their job history? Where have they lived in the past, and so on? All of that is used to reduce asymmetric information in combination with using the house as collateral. So the takeaway from this discussion on mortgages is that collateral can reduce asymmetric information and adverse selection But I think a big emphasis should be placed on the moral hazard idea. The fact that it reduces the moral hazard problem and requires people to live in the residence most of the year. And the assumption there is that the owner is managing and keeping up the value of that property so that if there's ever a default, the bank has a property that's been relatively maintained over the years. So now let's look at the problem of asymmetric information and equity, meaning stock. And I can think of two easy examples associated with that. The first one is very common when you read this literature on asymmetric information and equity. I'll get to that in a minute. But the first one is this. It has to do with dividend increases. In the stock market, when a company announces that it's going to increase its dividend, the stock usually jumps. And the reason for that is shareholders know they don't have the full information that management has about the company, and that the management knows a lot more about the day-to-day operations than the shareholders. And the other aspect that you need to realize is that companies, when they declare dividends and they increase dividends and they pay dividends, they expect to pay that dividend consistently into the future. So if you watch dividends for various companies, they rarely cut dividends. And if they cut dividends, their stock price is severely punished and management is severely punished for not being able to keep that dividend up. It's a loss of confidence. So when companies increase dividends, it's a signal that management is really confident of its future cash flows and prospects. Otherwise, it would not increase that dividend. So when shareholders hear the announcement that the company's increasing dividends, the stock price jumps dramatically often as asymmetric information is reduced. Now, the second issue associated with asymmetric information and equity is the principal agent problem. The principal agent problem works like this. Shareholders elect a board of directors, and the board hires management. And management works day to day in the business, and they're separated usually from the shareholders of the company. So you can own shares in a company that's running in California and be living on the East Coast. You have no idea really what's going on a day-to-day basis. A problem arises in that management may be using corporate money in a way that shareholders don't approve of. It could be small things like top management getting cars that are paid by the corporation. Could be longer vacations that they're getting. Could be that they're spending money on lavish lunches and offices. But it's even bigger than that. It can also be that managers will invest in capital expenditures that really are not worth the cost and simply are not a good fit for the company, but may be a pet project. Another really biggie is the management could be trying to buy and acquire other firms simply to make the company bigger. So when you make a company bigger, there's usually a bigger paycheck that goes associated with it. So if you look at this, you look at executive salaries based on firm size, you see that the larger the firm, the larger the salary and bonuses. Therefore, managers will often buy businesses, even if they're not lucrative and they may not be the best fit for the company, only to make it bigger. So these are generally moral hazard problems. Adverse selection is not really considered because, management's already been hired. They could have been hired a long time ago. So we're not looking at adverse selection. We're looking at a moral hazard problem. So how do you remedy this moral hazard problem? Well, that's where people got the idea years ago to pay managers bonuses that depend on profitability and also to give managers options, stock options. Why would they do that? Well, stock options and bonuses that are based on profits align the manager's incentives and goals. And so what are the goals of shareholders? Maximize stock price. So therefore, options can be used to maximize shareholder value and align management's incentives with shareholders. In other words, it mitigates the moral hazard problem that shareholders just don't know what management's doing. So now, what about asymmetric information and debt? Well, the main concern here is moral hazard, although adverse selection is also present. And so how do we mitigate these things? Well, with restrictive covenants. Restrictive covenants keep the borrower from performing certain activities. For example, well, if you lend money to a company, what prevents that company from borrowing money again? Making it senior debt. So here we have senior versus subordinated debt issues. If you lend money to a company, all fine and good, but what happens if the company turns around and later borrows more money? And not only does it borrow more money, it now borrows money that's senior to the debt that you have lent. That means if the corporation you lent money to goes bankrupt, then you're going to be second in line to get your money. The borrower that came after you ended up with senior debt, and they got paid off first. So part of your restrictive covenant would be to restrict any senior debt beyond what you've lent the company. So we're dealing with mitigating a moral hazard problem, but it also mitigates an adverse selection problem, because if the borrower realizes that they're going to have to comply with restrictive covenants, that may cause the borrower to think twice as to whether or not they want to borrow the money, or reduce the number of potential borrowers. The other thing that comes about is there's financial disclosures. And the financial disclosures are, for example, debt to equity ratios. That would mitigate moral hazard problems. Profitability ratios, cash flow estimates, all of those things reduce moral hazard and is likely to reduce the chances of the loan not being paid back. So there you have it, asymmetric information, adverse selection, and moral hazard. We barely scratched the surface. This is a really deep and cool topic, but we can't spend too much time on it. We got to move on.